All right, guys, thank you for joining again. This is the last class of the Swing Trading Blueprint. And today we're going to talk about risk management techniques. All right. Risk management is, to me, by far the most important thing that every single trader and investor must understand. If you don't understand risk management, what will happen is you will put yourself in position to end up losing more money than you could potentially gain from each position that you take. So with proper risk management, we want to make sure that we have a balance in our portfolio. We want to make sure that we have our money spread out through different assets and different sectors to make sure that if one sector does bad, it doesn't do too much damage to our entire portfolio. And also with each individual investment and each individual trade position that we have, we want to make sure that we calculate what the potential gain could be compared to the potential loss in each position, and make sure that your risk to reward ratio makes sense every single trade you take. And we're going to go through the whole breakdown of how much money you need in each position compared to what you have in your overall portfolio, and a lot more. So let's go ahead and get into it. And hopefully you guys will have a very good understanding of how to handle your risk management, and understand that without risk management, what you'll do is put yourself in a place to where you'll end up tapping out of the market before you give yourself the opportunity to get better and reach the goals that you set for yourself in the long run. So we essentially want to afford ourselves the losses that we're going to take in this journey. You're not going to win 100% of the time. There's no trader on earth who wins 100% of the time. You're going to take losses. The issue that you have to solve, the problem that you have to solve is, how much of a loss can I afford to take on each position, and how many losses can I take before I eventually tap out and don't have any more money left to trade or invest. So we're trying to protect you from that, and protect you from getting to the point to where you don't have any more money left because you lost too much. Each single position that you take, you're only going to, if you lose, you're only going to lose a small piece of your overall position and not your overall account. All right, so let's go ahead and get into it. Risk management techniques for active traders. Risk management helps cut down losses. It can also help protect a trader's account from losing all of his or her money. The risk occurs when the trader suffers a loss. If it can be managed, the trader can open him or herself up to making money in the market. It is essential, but often overlooked prerequisite to successful active trading. After all, a trader who has generated substantial profits can lose it all in just one or two bad trades without proper risk management strategy. So how do you develop the best techniques to curb the risk of the market? This presentation will discuss some simple strategies that can be used to protect your trading profits. Trading can be exciting and even profitable if you are able to stay focused, do due diligence, and keep emotions at bay. Still, the best traders need to incorporate risk management practices to prevent losses from getting out of control. Having a strategic and objective approach to cutting losses through stop orders, profit taking, and protective puts is a smart way to stay in the game. A Chinese military general, Sun Tzu, famously said, "Every battle is won before it's fought." This phrase implies that planning and strategy, not the battles, win wars. Similarly, successful traders commonly quote the phrase, "Plan the trade and trade the plan." Just like in war, planning ahead can often mean the difference between success and failure. First, make sure your broker is right for frequent trading. Some brokers cater to customers who trade infrequently. They charge high commissions and don't offer the right analytical tools for active traders. Stop loss and take profit points represent two key ways in which traders can plan ahead when trading. Successful traders know what prices they're willing to pay and at what prices they're willing to sell. They can then measure the resulting returns against the probability of the stock hitting their goals. If the adjusted return is high enough, they execute the trade. Conversely, unsuccessful traders often enter a trade without having any idea of the points at which they want to sell at a profit or at a loss. Like gamblers on a lucky or unlucky streak, emotions begin to take over and dictate their trades. Losses often provoke people to hold on and hope to make their money back, while profits can entice traders to imprudently hold on for even more gains. Consider the 1% rule. A lot of day traders follow what is called a 1% rule. Basically, this rule of thumb suggests that you should never put more than 1% of your capital or your trading account into one single trade. So if you have $10,000 in your trading account, your position on any given instrument shouldn't be more than $100. This strategy is common for traders who have accounts of less than $100,000. Some even go as high as 2% if they can afford it. Many traders whose accounts have higher balances may choose to go with a lower percentage. That's because as the size of your account increases, so too does their position. The best way to keep your losses in check is to keep the rule below 2%. Any more, and you'd be risking a substantial amount of your trading account. So understand that this example is based on day trading. All right, day trading has way more volume than what swing trading would bring to you. So this 1% or 2% rule can be applied to people who like to day trade, where you're going to have extreme movements throughout the day and put your money at risk more than what a swing trader would, right? So with a less risky strategy like swing trading, I'm comfortable with going all the way up to 5%. So anywhere between 2 to 5% for a swing trading position, to me, is comfortable. And what that basically means is for each position that you own, that you have, 5% of your entire account balance is in that one specific trade. So basically what that means is, let's just say that you were totally wrong about the movement of the stock and you didn't have a stop loss and you just jumped into the trade and that was it. If that is, if that's the case and you're wrong, then you will lose 5% of your entire account. Now, if you lose 5% of your account on one trade, that's not going to kill you. It might make you angry. It might not make you happy, but it's not going to give you, it's not going to put you in a place to where you can't trade anymore. Essentially, you still have 95% of your entire account left over so that you make sure that you don't make that mistake again. You won't be in that place again. So 5%, 2 to 5% is comfortable for a swing trading position. And then we'll get into detail about how to protect that position, because essentially what we're doing is we're getting to the point where we have about 5% of our account in one specific trade. And then if we're wrong on that trade, we're not going to lose that whole 5%. We're only going to lose a small percentage of that 5%. And we'll get into detail about that in a minute here. All right. So set and stop losses and take profit points. A stop loss point is the price at which a trader will sell a stock and take a loss on the trade. This often happens when the trade does not plan out the way the trader hoped. The points are designed to prevent it will come back mentality and limit losses before they escalate. For example, if a stock breaks below a key support level, traders often sell as soon as possible. So this is one of the issues that a lot of new traders have. They find it very hard to just take a loss and move on. You're going to get to the point to where it has no effect on you whether you win or lose. It's just part of the game, and you just continue to move forward. I always go back to sports. With me playing in professional sports, we have a season, right? So overseas, we had a season where we might have about 30-something games, 34, 40 games, not including the playoffs, right? We already know the schedule. We know what days we're playing on. We know what teams we're playing on. If we have a game on Friday and we lose, it's not one of those things where you beat yourself up for the rest of the season. You have another game the following week. So what you do is you go to practice that week and you work on the mistakes that you made during the game. You watch film, you point out all the things that you can tweak and fix. And then and we only spend about 2 or 3, maybe 3 days max talking about the game that we lost. And then the rest of the week for the practice, we talk about the game that's coming up ahead. Sometimes on good teams, on good winning teams, we might only spend 1 day talking about the loss. The rest of the time we're spending talking and preparing for the next game. We're done with that. It's over. It's on our record. Fine. Let's leave it. Let's move on. We're on to the next game now. Same thing that goes on the other side. If we win a game, we win on Friday, we're only going to spend 1 or 2 days talking about the win on Friday. We got another game coming the next week. So there's no reason for you in trading and investing to dwell on the losses or celebrate the wins too much. You have to move on and prepare for the next position, prepare for the next trading opportunity, prepare for the next setup, and then make sure you do spend some time tweaking and making sure you understand why you might have lost the last trade. So that way you don't make the same mistakes over again. But what you want to make sure you do is understand where the stock price is going, set your stop loss. And if your price gets close to your stop loss, for me, sometimes I don't always let my stop loss get hit. If I see it's going in that direction, I go ahead and get out of the trade earlier. So that way I can limit my losses even more. And understand that, remember, the stock market is 70 to 80% bullish. If you're taking a long position and the price goes against you and it starts to drop, essentially what's happening is, yes, you might take a loss, but if you look at the other side, you know that eventually that price is going to end up coming back. So you need to start preparing for that and then put yourself in position to buy that same stock at an even lower price. And then in turn, you will be able to make up everything that you lost and more. So don't dwell on the losses. If you see a loss is coming, go ahead and take it, move on, learn from it, but move on. And then also make sure you keep that stock on your radar, because at some point it's going to turn back around and you need to be there to get your money back. All right. On the other hand, a take profit point is a point at which a trader will set a stock and take a profit, sell a stock and take a profit on the trade. This is when the additional upside is limited given the risk. For example, if a stock is approaching the key resistance level after a large move upward, traders may want to sell before a period of consolidation takes place. So we just talked about the cycles of the market, understanding that stage one, consolidation, breakout, stage two, upward trend, stage three, consolidation, stage four, breakout to the downside, downward trend, right? What we're talking about is setting a take profit point at the top where the resistance level might be seen. And when the stock price hits the resistance level, we start to get into a stage three when it starts to consolidate and move sideways. Sometimes traders don't want to get caught in that sideways movement. They understand what's coming next after that stage three, stage four decline, right? You don't want to get caught in the stage four decline. So to protect yourself from that, you set your take profit point as soon as you get into the trade, as well as your stop loss point. So when the stock price goes all the way up and it hits your take profit point, you automatically sell, you automatically exit that position. You're taking on your profits, you're done, and you're moving on to the next trade. That's essentially what you're doing. All right. So how to more effectively set stop loss points. Setting stop loss and take profit points is often done using technical analysis, but fundamental analysis can also play a role in timing. For example, if a trader is holding the stock ahead of earnings as excitement builds, he or she may want to sell before the news hits the market if expectations have become too high, regardless of whether the take profit price has been hit. Moving averages represent the most popular way to set these points, as they are easy to calculate and widely tracked by the market. Key moving averages include the 5, 9, 20, 50, 100, and 200-day averages. These are best set by applying them to a stock's chart and to determining whether the stock price has reacted to them in the past as either a support or resistance level. We talked about this in the introduction to technical analysis. You guys should pretty much understand how the moving averages react to the stock price and how they can be used with resistance and support levels as well. So those are definitely going to be key for you moving forward. All right. Another great way to set stop losses or take profit levels is on support or resistance trend lines. These can be drawn by connecting previous highs or lows that occurred on significant above average volume. Like with moving averages, the key in determining levels at which the price reacts to the trend line, and of course, on high volume. When setting these points, here are some key considerations. One, use longer term moving averages for more volatile stocks to reduce the chance of that meaningless price swing that will trigger a stop loss order to be executed. So like I said, if you're going from a daily chart and you move all the way down to a 1 hour chart, just understand that those moving averages and the price movement in general is going to be a lot more violent than the movement on the daily chart, right? So as long as you understand that, that will keep you honest when it comes to setting your take profits and stop loss, especially stop losses, because sometimes what happens is people set stop losses too close to the price, to the current price, and you need to give the price time to breathe, because again, the stock market doesn't just go straight one way or the other way. It's going to zigzag up and zigzag down and even zigzag sideways. If you understand that and you know that, it doesn't make much sense for you to set your stop loss so close to the current price, because you know that in any given day, the stock price can drop $5, $6, $7, $8, $9, $10 and then go back up 20. And if that happens to you and you set your stop loss at $5 below the price, and the price goes all the way down $10 and then comes back up and closes at 20, you essentially got stopped out with a wick. And that's the worst feeling to have. So having those support levels there and understanding what the moving averages are and support levels in general as far as market structure, that will help you stay honest about your stop losses. What I normally do is I not only give the price room to breathe, but I go to the next level and put my stop loss under the support. So even if the stock price drops to the support level and bounces back up, sometimes a wick might go below the support level a little bit before the stock price goes up in the opposite direction. I don't want to risk getting wicked out. I've gotten wicked out so many times when I first started out trading, and that's one of the keys that I learned to help me move forward, where I can just literally sit back and watch the stock price go down and get close to my stop loss, but not hit it, turn around, bounce off support, and then go in the opposite direction, and I'm back in profit. So make sure that you understand that, and we're going to give you some examples of that when we pull up the chart. All right. Adjust the moving averages to match the target price ranges. For example, longer targets should use larger moving averages to reduce the number of signals generated. So 200-day moving average, 50-day moving average, you're not going to get triggered but too many times with those two big moving averages. 20 moving average, sometimes, yes, if the stock price is getting to the point to where we're getting closer to a stage 2 breakout, you might get hit up. The resistance level will be the 20 moving average. You're waiting for the resistance level to get crossed so you can start looking for an entry. And when that happens, sometimes you'll see the stock price hit up against the 20 moving average a few times, maybe even wick above it and come back down. Those are triggers. That would be considered a trigger. You get triggered so many times and the stock price doesn't really go where you think it's going to go. That might not matter as much as long as you have your stop loss under the price movement. You can deal with all of those false triggers and false movements as long as your stop loss is in the right place. All right. So stop losses should not be closer than 1.5 times the current high to low range, as it is too likely to get executed without reason. And that's basically what I just described when we talk about false triggers and wicks coming down and bouncing back up. Give the price some space, give the price some room to breathe, and then you'll be okay. All right. So adjust the stop loss according to the market's volatility. If the stock price isn't moving too much, then the stop loss points can be tightened. Use known fundamental events such as earnings releases as key time periods to be in or out of a trade, as volatility and uncertainty can rise. So we understand that the earnings calls can cause a whole lot of volatility and a whole lot of movement that might not be normal for that particular stock if there wasn't such a catalyst like an earnings call. We can use that to our advantage, but also it could be to our detriment if we are on the wrong side of the market. So some people like to stay off of the earnings calls. Sometimes you'll see a stock moving in a certain direction. You'll be able to jump into that stock maybe a week or 3 or 4 days before the earnings call. You might hit your target. If you hit your target, that would be a good time for you to go ahead and get out of the trade, because what could happen is the earnings call and the catalyst on that day might come out and turn the stock completely around in the opposite direction, and you take away all your profit and end up getting stopped out. And that's not what you want to happen. So don't get greedy and think that a good earnings call is coming up and the stock price is going to shoot above and give you double of your profit. If you're already at a point to where it's okay to take profit before the earnings call, don't hesitate to do that. Don't get greedy. The market is going to give you what the market is willing to give you. You can't just try to take and persuade the market to give you something because you want to make money. It doesn't work like that. Okay. Calculating expected return. Setting stop loss and take profit points are also necessary to calculate the expected return. The importance of this calculation cannot be overstated, as it forces traders to think through their trades and rationalize them, as well as it gives you a systematic way to compare various trades and select only the most profitable ones. This can be calculated using the following formula. So there's a formula here, obviously, but you don't necessarily need to memorize this and practice this formula. I showed you an example in the previous class of what the position tool looks like. I'm going to show you how to use the position tool and how to use the information on that tool to calculate your risk to reward ratio. So that way you can make sure that you are on the right side of the market. Not only that, but also make sure that you're taking the right amount of risk compared to the potential reward that you might get if your stock price hits your take profit point. All right. So the result of this calculation is an expected return of the active trader, who will then measure it against the opportunities to determine which stock to trade. The probability of gain or loss can be calculated by using historical breakouts and breakdowns from the support or resistance levels, or for experienced traders by making an educated guess. All right. We don't want to make guesses unless we're just guessing on what direction the stock might go. But we try to limit the guesswork. We want to make sure that we get high probability trade setups and high probability targets compared to previous price movement, as well as making sure that we measure our risk to rewards to make sure that taking that trade actually makes sense for us. All right. So diversify and hedge. Making sure you make the most of your trading means never putting your eggs in one basket. If you put all of your money in one stock or one instrument, you're setting yourself up for a big loss. So remember to diversify your investments across both industry sector as well as market capitalization and geographical region. Not only does this help you manage your risk, but it also opens you up to more opportunities. You may also find yourself at a time where you need to hedge your position. Consider a stock position when the results are due. You may consider taking the opposite position through options, which can help protect your position. When trading activity subsides, you can then unwind to hedge. So that's what we first started talking about when we got on, when we first started this class, was making sure you spread out and diversify, and that's basically portfolio management. So you want to make sure that you have a good balance in your portfolio and not have too much weight in each individual sector or too much weight in each individual industry, right? So one common mistake that a lot of traders make is a lot of traders, they jump on the tech wave because tech, is very, they're growth stocks. So they're fun, a lot of volatility, a lot of media coverage, a lot of promising results. You'll see the history of the market where you see some of these companies have given 30, 60, 100% returns over a course of 3 or 4 months. And people see that, and that's very attractive, especially for someone who wants to get as much bang for their buck as possible trading or investing. So that might be a reason why a lot of people put money into those particular sectors. But that right there shouldn't be something that you want to put the majority of your portfolio value into, right? So if you're someone who's managing $5,000, it wouldn't be smart for you to put, $7,000 into tech, because what happens when there's a sector rotation? What happens when the tech stocks and growth stocks start to decline and the value stocks start to go up? You put yourself in position to lose a large amount of money. And you're either going to have to do one or two things. One, you're going to have to minimize your position, or you're going to have to use an advanced strategy to get protective puts using options trading to try to balance out your portfolio. And we also have an options trading class available for those of y'all who want to learn those advanced techniques. Options traders can be very, very lucrative for you. It can be also risky, but it depends on what strategy you use with it, especially if you want to keep your portfolio balanced and use it as somewhat of an insurance policy against a decline in your stock price. That could be a very, very great strategy for you to use. So you can definitely tap into bstuniversity.com and get into the options trading course, and you'll see how valuable that information can be for you moving forward. All right. All right, so downside put options. If you are approved for options trading, buying a downside put option, sometimes known as a protective put, can also be used to hedge the stem the losses from a trade that turns sour. A put option gives you the right, but not the obligation, to sell the underlying stock at a specified price at or before the option expires. Therefore, if you own XYZ stock from $100 and buy the 6-month $80 put for $1 per option and premium, then you will be effectively stopped out from any price drop below $79. $80 strike minus the $1 premium pay. So this is into options trading again. If you want to learn more about options trading, you will simply sign up for the options trading class. And when I'll tell you, I'll teach you everything you need to know, okay? So the bottom line is traders should always know when they plan to enter or exit a trade before they execute. By using stop losses effectively, a trader can minimize not only losses, but also the number of times a trade is exited needlessly. In conclusion, make your battle plan ahead of time so you'll already know you've won the war. For related reading, make sure you go ahead and check out the basic methods for risk management. So we're going to get into the basic methods of risk management and start talking about some of the things that I do to manage my my positions when I'm trading. All right. So let's talk about our risk management and profit goals. Okay. All right. So risk management and profit goals. All right. All right. So risk management and profit goals. All right. So this is going to be provided for you, obviously, in the back end. You can go in and download this document, right? This is my swing trading plan every single month. Okay. Well, let's break it down. So my monthly goal is to make 5 to 10% profit on my entire account, right? So if you're dealing with a $1,000 account and you have $1,000 in your account, what you want to do is you want to put yourself in position to make at least 5% every single month in returns on that account, right? So let's just do the math so we can get a good representation of what we're talking about here. Minimize this real quick. I like to use this calculator because this is you know, something that we need to visualize and understand, right? So $1,000 in your account total, right? You want to try to make a 5% return on that, which will give you a $50 return at the end of the month, right? So for someone who has a $10,000 account, 5% gain on a $10,000 account is $500 a month. So basically what you're doing is you're getting yourself to a position where you have $10,000 in capital and you're successfully trading using the swing trading methods and getting a 5% return minimum each month. That would give you an extra $500 profit each month that was created off of each swing trade, which is basically passive income, right? Because you don't really necessarily have to do too much work in this game other than just clicking your mouse and doing a little bit of studying. So that's what we're essentially trying to do. Now, for the people who've been following me for a while and the people who understand me and my philosophy and what I consider this whole game is about and how to approach it, we have a lot of people who are coming in from a situation where they are having a 9-to-5 job. A lot of people don't like their 9-to-5 job. That's fine. But what are you doing about it? And what are you doing to set yourself up to exit that situation that you don't really like too much? What you want to do is you want to give yourself as many opportunities as possible outside of your job to create passive income first, but just alternate or other streams of income that can help you get enough money that can actually either equal or supersede the amount of money that you're making with your 9-to-5 job. Once you get to that point, you can start to give yourself options, right? So a lot of us work these 9-to-5 jobs that we don't like because we don't have any other option. The option that we're talking about is what else can I do that's going to make me this amount of money or more that I might enjoy more than what I'm doing right now, right? You have to give yourself those opportunities. So with swing trading, what that will do for you is it will help you gain that extra income that you're looking for. Now, it's going to cost money to play the game, all right? The more money you have, the more money you're going to make. So this 5% number right here is going to grow with the amount of money that you have in your account. So again, if you have $10,000 in your account and you get a 5% return, that's an extra $500 a month, all right? Now, one of the things that I tell my mentees and my students is it doesn't really matter where you're at in life. you need to give yourself a goal of getting to at least $100,000 in your account. Now, a lot of people are going to hear this and say, oh man, that's impossible. That's impossible. Not necessarily. If you have a 9-to-5 job and you've been working that job for 20, 30, 40 years, and you're dealing with a retirement account where you're contributing consistently to your 401k or your IRA, you're going to eventually have somewhere close to $100,000 in that account. So it's not far-fetched to you to think that you can get there, or understand that you can get there with the investment account or the retirement account that you have with your job. Then it shouldn't be any different than with your brokerage account outside of your job. You just have to make the commitment to contribute money consistently, right? So we have opportunities here where we have free money coming in from stimulus. We have free money coming in from child credits. We have free money coming in from whatever other situation they might arise in our economy that will allow us to get some extra stimulus that the Federal Reserve is printing out these money and giving it out to us. We can use that as an opportunity for us to contribute to our portfolios, or we can just have a better method of budgeting. And I'm pretty sure some of us have things in our closet that we don't necessarily need, right? So you can always go and sell some of the stuff that you don't really need at this particular point. You got so many different websites you can list your products on. You have I don't know. I can go on a whole list of different platforms where you can list your shoes and clothes and bags and watches and everything that you might not necessarily need to survive off of right now. What's more important, right? So the most important thing for you is to try to put as much money into your brokerage account as possible. Now, a lot of us use our savings accounts, for instance, where you feel like you want to save up for a rainy day. There's absolutely nothing wrong with saving for a rainy day, right? But what happens when it actually rains? When it actually rains and you go into that savings account and you use that money for whatever happens, the money's gone now. So now you have to start working on building another savings account. But what if you had that same amount in your savings account in a brokerage account, right? And you don't necessarily have to put all of it at risk, but what if you risked a small portion of it, or even a half of it, and you were gaining returns on that consistently over the month-to-month period, or a yearly period, right? When that rainy day comes, you might get to the point to where you have enough profit to take care of whatever happened and still never have to touch the original principal that you saved. That's what essentially we're getting to. So this concept here of gaining a return, what I want you to think about is how to live off of your returns and not the principal. So when you get to the point to where you stack up enough principal in your brokerage account and you're successfully trading from month to month, the returns is what you're actually living off of. The principal never gets touched, right? So if we have $10,000 in our account, essentially what we're saying is that $10,000 is going to stay there forever. And if we ever get to the point to where we have a losing streak and that $10,000 number starts to get a little bit lower, we have to have the obligation to actually contribute the money back to our account to even ourselves out. That would be considered a loss, right? And we have to take that loss and we have to go ahead and compensate our own account with the money that's coming out of our pocket or our job or wherever other income stream you have, and put it back. All right. So 10% on $10,000 would be $1,000 a month. That would be a very good, successful month, right? So let's just say, for instance, you have 100% of that money being used in positions to trade. If you're only using 5% of your entire account on each position, you will give yourself the opportunity to hold at least 20 positions at a time. Now, that might be too hard for a lot of us to manage, especially starting out in the beginning. But for me personally, I think it's very, very easy to manage 20 trades at a time, considering that we're really not doing any work at all. We're setting our stop losses, we're setting our take profits, we're making sure that we're getting in at good entries and good setups. And once we purchase the stock, we basically leave it alone until it's time for us to exit, right? We're using our indicators, we're using our take profit points, and we're looking periodically to see how the prices are moving and if it's time for us to get out of the trade or not. And once it's time for us to take off our profits, then we take off our profits and start to close or minimize our positions as they get bigger and bigger, right? So managing a 20 position portfolio at a time is not a hard thing to do, but you might need to work yourself up to that, right? But let's just say, for instance, you had 100% of your portfolio into trades, and each trade that you're managing has only a 5% allocation of your entire account into that position. That will give you the ability to trade 20 positions at a time, right? So the position size is 5% or less of your entire account. So if we do the math, we can look at a $10,000 account and say 5% of that $10,000 is $500. So essentially what we're saying is the position weight is only $500 max, okay? So the size and the weight, two totally different things, but they kind of mean the same thing, but you need to think of them in different terms. Size is the percentage, right? The weight is the dollar amount. So at one point, successfully traded, your weight and your size is going to get so big to the point of where you need to cut down some of that position, right? So we're going to give you a couple of examples when we look at the Datorama resource that I gave you in the previous class, where we start looking at these big hedge fund managers who manage millions and billions of dollars and look at how they manage their portfolios and see what the allocation looks like. Yours should look no different than theirs, all right? So a 1-to-2 risk to reward ratio per trade. We're going to look at the position tool and make sure that each time we jump into a trading opportunity, we can see where our potential take profit is. We'll see what our potential stop loss is, and we have to manage that position by understanding what the risk to reward ratio is. And for me, a good risk to reward ratio is about a 1-to-2 or 2-to-1. And on some cases, you might be willing to risk a 1-to-1, but for the most part, you need to look at a 1-to-2 risk to reward ratio every single time. If you cannot get a 1-to-2 risk to reward ratio that makes sense, you can't force it. It has to make sense. When we're talking about support and resistance levels, it has to make sense. If it doesn't make sense, then you can't take the trade. All right, it's not worth you losing your money to try to shoot for something that doesn't give you as much of a return as you might be able to get compared to the risk that you're taking on. All right, so a 10% gain on $500, that's a $50 win each trade, right? So if I take 5% of my $10,000 account and put $500 into one trade, and I'm looking at my risk to reward ratio, and I'm looking at it and I'm saying that I'm going to risk 5% of my $500 in an attempt to gain a 10% of that $500, I am now putting myself in position to potentially gain $50 profit. Or if I'm completely wrong, I'm only going to lose 25%. I'm sorry, $25 of my $500. So that's what I said when I mentioned when we references the 1-to-2% rule when it pertains to day trading. But we're swing trading, so it's comfortable for you to take a 5% size on your entire account for each trade, understanding that I'm not going to just lose the whole 5%. I'm only going to lose a small percentage of that 5%, right? So I'm not going to lose the whole $500 on this trade. I'm only going to lose $25 of this trade. So now you start to see how you can continue to stay in this game, even if you have a terrible month and just lose every trade you take. You're only losing a small piece of each position, and that's going to keep you in the game long enough to where all you need is a couple of wins, right, to make up what you lost. So in this particular scenario, you're giving yourself the opportunity to lose 2 trades. And if you win one, you break even. That's essentially what you want to be shooting for every single time you jump into a position, right? You want to give yourself the opportunity to make up for whatever you might have lost with the previous 2 or 3 trades with one win, and it cancels everything out and you continue to move on in a more profitable space. All right, so an example would be Paul Tudor Jones, right? He's a billionaire hedge fund manager and he's a swing trader. He got very, very famous off of his method where his risk to reward ratios were always 1-to-5. So basically what that means is he was only willing to risk 1 in order to gain 5. So in this scenario, you would be looking to risk a 1% of your position in order to get a 5% return, right? Or 5% of your position in order to get a 50% return, right? So that's essentially what you can shoot for. Those opportunities will be there for you, but an opportunity like that will take you probably a longer amount of time in order for you to actually see your take profit get hit, right? So in order for you to get, and I'll show you on the chart how difficult it might be for you to find those opportunities, especially in a market like this where a lot of things are already overpriced. You have to find a good sale. You have to understand support and know that the stock price is not going to go below that price level. And then your take profit point has to be high enough to where that risk to reward ratio equates to a 1 to 5, right? So another thing that we want to talk about, and I already kind of spoke about this briefly, but never stop raising capital. So like I said, it's a lot of us out here who really are uncomfortable with the position that they're holding at their job situation, right? Constantly searching and constantly looking for an opportunity for them to quit their job and jump into something that they might have more fun doing. What I suggest is not to quit your job, all right? But just change your mentality. So if you're showing up to work every day and you know that you don't like this job and you want to, you're hoping and praying for an opportunity to come so that you can walk away and jump into something new, and you're waiting for that, right? Instead of having that mentality, now you go to work with the mentality of, I'm just here to raise capital. I'm just here to raise capital. I'm raising capital the same way a hedge fund manager would, where I'm going out there and I'm politicking and I'm networking and I'm trying to solicit my service and show people what type of returns I can get. And all I need them to do is cut me a check so I can add it to my fund. And now I have more capital to trade with, right? So in this particular case, your job is giving you the capital that you need to put towards your portfolio. Okay, so whatever you're getting paid at your 9 to 5 job, every single time you get a check on Friday, your mentality should be, okay, yes, now I have more money to put into my fund. And now I have more money that I can manage, which means I have more positions that I could potentially take, or a bigger weight or bigger position size, or keep my position size the same, but my position size now holds more weight, right? Because I'm dealing with more money. So now, instead of me being frustrated about my situation, I'm a little bit more excited to show up to work because I know that all I'm doing is I'm raising capital. So if I started out with $10,000 with a mentality of, I can't wait to get out of this job, I can't wait to get out of this job, I'm pumping my brakes now. Now I'm showing up and I'm saying, what can I do to get extra? Because at the end of the day, the more money I put into my portfolio, the bigger weight my positions are going to be. The bigger the weight my positions are going to be, the more returns I'm going to get on each trade. So if I have $10,000 in January and I hold my job down until December, I might put myself in a position to where I end the year out with a $15,000 portfolio instead of a $10,000 portfolio. If I use these same numbers and have a position size of 5%, that 5% has now increased to 750 in weight. Now, if I have that 750 instead of a 500 with a 10%, a 5 to 10% risk to reward ratio, right? That same 10% gain is going to get, that same 10% gain is going to get me $75 in return. So prior to that, I was working with a $50 win. Now I'm working with a $75 win and nothing changed as far as my position size, nothing changed as far as my risk, nothing changed. Only thing that changed was I'm dealing with more money now. So now I can afford to increase my position weight without having a huge effect on my portfolio if I were to take a loss. All right. So like I said, the goal at the end of the day should be $100,000. If you get to the point of where you can actually raise $100,000 in capital, and it can be done, especially when we're dealing with a situation where we're making money off of money. So the money that you're actually making from the market is giving you more money. On top of that, you're contributing more money. So at the end of the day, you might be able to pull an extra $5,000 in savings out of your job and put towards your account, right? But what about the money that you've been making from successfully trading? You might have ended up making a $5,000 return at the end of the year. That gave you $10,000. So now instead of a $10,000 account, you might be sitting on a $20,000 account. What if we use this same scenario and we end up getting a 10% return on our trade? That's a $2,000 win on one trade. Or I'm sorry, that's a $2,000 win each month. So we're trying to get a 5 to 10% return each month. If you're dealing with $20,000, you got $20,000 in your account and you're getting a 5% return each month. That's an extra $1,000 to your name at the end of the month. And all you had to do was get a 5% gain. I could show you 15 or 20 trades that I'm in right now that are already at 5%. I'm in an options trade right now with IGF and I'm up 14%. I'm in a swing trade with City Trends right now and I'm up 11%. I'm in a swing trade with Etsy right now and I'm at 11%. I'm in Tronics right now and I'm up 5.85%. I'm in Toll Brothers right now and I'm up 5.53%. I'm in DPW right now and that's a penny stock and I'm up 6.18% on that. So it's not far-fetched for you to get a 5% return at the end of the month. That's relatively easy. Overall, right now, in the beginning of September with these new positions, I'm up 2.85% overall with my total portfolio. I only got to get 2% more, almost 2% more, a little bit more than 2%, and I'm good for the month with my 5% return. Now I have obviously more than $10,000 in my account, but these examples still apply, right? These examples still apply. So it just depends on how much money you have in your account and how many positions are you holding. So for me right now, I'm in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. I'm in 17 positions right now. I was in 18. I got stopped out of one position early this morning. No problem. I got stopped out of my position. I lost about 3% of that position, right? Again, 5% max on position size. In my case, I normally don't even get up to 5% because there's no need, it's not necessary for me to take on 5% in position size because I've done pretty well with managing my risk, managing my portfolio, and understanding what setups are right for me. I don't need to stretch myself to 5%. I can still get the results that I'm looking for without putting a 5% position size on each position I'm in. I can do a 3, I can do a 4, and still get a 5 or 10% return each month. Now, I'm not saying that every single month is going to be an amazing month. You're going to have some losses each month, but you're also going to have months where you hit it out the park and get a 10 or 15 or 20% return. It's balanced. At the end of the year, let's tally it up and see what side of the game we're on, right? So what you're doing is you never stop raising capital. So if your job is your only source of income, then cool, keep your job. If you are a hustler and you got some other things going on with other streams, then use those as well. Try to figure out what you can do to help you gain a little bit more income each month. And then you use that extra income to contribute to your portfolio so that way you can afford yourself to get more money and afford yourself to take some of those losses. So cover all of your losses. I spoke about this before. Let's say, for instance, if I'm dealing with a $10,000 account and I have a terribly bad month and I end up losing $1,000, right? I lose $1,000. If I lose $1,000, then I have to do everything in my power to make sure that I take $1,000 out of my pocket, out of my savings, out of my job, out of my other income streams, and put it back into my portfolio, because the last thing I want to do is put myself in position to where my position weight gets smaller and smaller and smaller. We want our position weight to get bigger and bigger and bigger, not smaller, all right? The bigger our position size is going to be, the faster it's going to be for us and easier it's going to be for us to have options outside of our day-to-day job that we might not necessarily like, right? We want our position weight to continue to grow by adding more money to our account. So if we end up losing, we have to put that money back and zero ourselves out each month. At the end of each month, we have to do that. We have to, all right? Continue to grow your account, all right? Continue to grow your position weight while keeping the same size. All right, so your yearly goal is a 60 to 120% gain. Now, a lot of people are going to say, man, it's hedge funds out there that can't get a 20 or 30%. How are you telling people that they're going to get a 60 to 120% gain at the end of the month? Very simple. 12 months of consecutive wins at 5 to 10% each month that will give you your 60 to 120% gain. Now, obviously, we're going to have bad months, but this is the best case scenario, 60 to 120% gain. Again, if you would have jumped into Tesla back in March of last year, 2020, and just had your money in Tesla alone, you would have got over 100% gain just from that. So it's not far-fetched for you to get 120% gain at the end of the year. It's just that most people only deal with index funds. Most people only deal with ETFs. And when you're doing that, you're only giving yourself the ability to have a 5 or 10% gain at the end of the year. If you go and check with your employer and figure out what they're doing with your IRA or your 401k, you'll see that the average IRA or or 401k is only going to give you about an 8 to 10% return, maybe a 12% return at the end of the year. The reason why is look at the investments that they're making in your portfolio. A lot of ETFs, a lot of indexes, a lot of funds, right? Not too many individual stocks. Individual stocks can give you those big returns. We're picking individual stocks. So there's a difference between the average portfolio and what we're doing. The average portfolio is going to give you a 5 to 10% return. If you just put your money in the S&P 500 and leave it, you're going to get a 5 to 10% return at the end of the year. But if you look at the individual stocks inside of the S&P 500, you'll see that some of those stocks from January to December are going to give you a 30 or 40 or 50 or 60% return over the course of 12 months, right? So you have to understand the difference and know that it's not far-fetched for you to get a 60 or 120% gain. You just have to be consistent with what we're doing, all right? And then every single month, make sure you keep adding to your account. The more you add to your account, the bigger your position weight, the bigger your returns are going to be, right? So now you start to see how all this stuff comes together. With my strategy, you're using your own money as leverage, all right? So a lot of people, what they do is, especially day traders, they borrow money and they use margin, right? A lot of these brokers are going to give you 50% or even 150% of what your portfolio value is at that particular point. So if I come in the game with $10,000, there's brokerages out there that's going to give me enough leverage to come in the game with $20,000 or even $35,000 or $40,000, $50,000, and I'm only coming in the game with 10,000, right? So that happens, and that's a form of leverage. And when you're doing that, it can be very beneficial if you know what you're doing, because you can maximize your gains, right? With using borrowed money, same concept. Now your position weight is even bigger, but you're not allocating all of your money into the equation. You're using other people's money, right? So your position weight has grown tremendously. And if you're right on the trade, then that return is going to be way bigger than what it would have been if you didn't have that amount of money to deal with, right? Same thing for losses though. So if you take a loss using margin, now you're ended up losing more money than you might actually have in your account. And that's when you end up getting a margin call and you have to actually owe the brokerage account instead of them helping you on the other side, right? So it might cost you $500 to enter a trade, but remember, you're not risking the whole $500. You're only using the $500 to make a return, right? So with options trading, which is a more advanced strategy, you're using other people's money, but with swing trading, you're using all of your own equity. So you can swing trade using leverage, right? And if you're options trading, you're automatically using leverage. But what we're doing is we're using our own capital. We're using our own money. In each position size and each position weight is what we're using as the leverage to get us more money. So that $500 on that $10,000 account, that $500 position is what we're using to help us gain the extra 50, gain the extra 70, gain the extra $100 off of that amount. And that $500 is principal. Once we take our profit off the table, we take that $500 and we put it right back to where it was, and then we move it into another trading opportunity. All right. So that's what we have for you as far as the risk management. Now, let's just use an example, right? This right here is a calculator that I have already calculated the equation that we just talked about before. So in this equation, let's just say, for instance, you start out with $10,000. That's your original initial investment. That's what your brokerage account is set at right now. That's your balance, right? Let's just say you put yourself on a savings plan and a contribution plan to where every single month you're adding an additional $500 to that $10,000 account, right? Just without trading anything, you're putting $500 in. If you put $500 in each month, at the end of the year, obviously your account balance is going to be way bigger than it was when you first started out. So $500 per month, multiply that by 12 at the end of the year, that's an extra $6,000 that you added to your account without trading anything. All right. Now, we do this for 1 year, right? Let's just say, all right, so in this instance, we have an interest rate, which is, I put 99. It's not necessarily an interest rate. This is a return, right? So this would be a percentage return. So like I said, our goal is to try to get a 60 to 100% return. The variance range is 20. So basically what I'm saying here is from 99 up to 20, so about 120%, down from 99, 20, which is about 60. So from 80 or 60% all the way up to 120%, that's your range, right? And so we're going to look at the median range at about 100% return. So let's say we get 100% return. All right, so we're compounding that monthly. So we're compounding that monthly. So every single month we're compounding the initial interest on that, and then at the end of the year, you put yourself in position to where you could potentially come out of this with about 40,000, 30,000 on the low end, $30,000. So if we start out with $10,000 and then we add an extra $6,000, right? Now you're looking at a situation where you have about $16,000, and each position that you hold obviously stays the same, so 5%, right? But then you have your position weight, which is bigger, and then each month you're going to get a 5 to 10% return from your wins, right? And at the end of the year, you look at potentially having anywhere between a 60 or 120% return at the end of the year, but off of the $16,000 going into the next year, right? So let's just do the math and say that we get 100% return on that. You get 100% return on that, that's another 16,000. You take that 16,000 and you multiply that by 2, and now you're looking at a situation where you have about a $32,000 account now going into year 3, right? So at the end of year 1, you was able to stack up 16,000. We're not even talking about you trading at this point, right? That's just you contributing money to add to the original 10,000 that you had. Year 2, now you're actually trading that 16,000 and you're getting a consistent 5 to 10% return every single month. By the end of year 2, you're dealing with an account that has grown up to $32,000. And now you're going into year 3 with a $32,000 account. And let's just say, for instance, you stop contributing after year 1 and you're only trading $32,000 up until this point. Look at what you're dealing with. Let's say, for instance, you continue to contribute $500 every single month. Look at what you might be dealing with. You find yourself in a situation where you have a $50,000 account and you only been doing this for 2 or 3 years, maybe 3 or 4 years, right? By the end of year 5, you should be at the halfway point of getting to that $100,000 goal, right? I'm not saying that it's going to take you 10 years to get there. Some of us are going to get there way faster, right? But I'm just showing you a procedure that you can take where it could speed up the process. So making a contribution every single month that's reasonable for you. If it's reasonable for you to contribute an extra $500 a month to your account, if you're able to start out with 10K, you'll see how easy it is for you to get to about $16,000 by the end of the year. And then going into year 2 now, trading and investing and actually getting these returns, look at where you're at, right? So it's not something that's far-fetched, and especially if you continue to keep that mindset of I'm raising capital, raising capital, raising capital, raising capital. Everything you can possibly do to get yourself some new income, some more income from different streams, whether it's your job, getting a raise, getting some overtime, or selling some things that you might not necessarily need, providing an extra service for somebody out there that might be able to pay you, and take that money, you put it into your brokerage account, and you do that consistently month after month. By the end of year 1, you're going to be in a totally different space than you started out with in the beginning of the year, for sure. All right, and I've seen this done. We do this all day. So everybody asked about taxes, all right? For those of y'all who know, Wise Tax and Financial Services. If you have any issues when it pertains to taxes, any issues when it pertains to filing, we definitely will be able to help you with that. This is a service that we provide, and a service that we are serious about. Also, financial services in general is something that I'm into. Financial planning, business consulting, credit consulting, all these different things. We are well equipped and able to help you on your journey when it comes to that. But just to keep it simple, right? People have questions about taxes and how do I manage my tax situation when I'm trading. To keep it simple, these are the tax brackets, right? So now you are looking at a situation where your gross annual income on this side, whatever your gross annual income is, just look at this regular tax rate, right? So long-term tax rate is for individuals who aren't necessarily trading, where they're investing for the long term and they plan on holding these trades for longer than 120 days or whatever the cap is. So it should be about 120 days. So longer than that, if you're holding your trades longer than that, or you're holding your investments for longer than that, then you automatically get thrown into the long-term tax rate, which is a little bit less than the regular tax rate. If you're using the strategies that I'm showing you, you're going to be taxed at the regular rate. Now, obviously, there's going to be a lot of deductions that you are able to take. $3,000 in net capital losses each year as of right now. Sometimes that rate gets adjusted according to how they want to play the capital gains taxes when it pertains to personal accounts and investments accounts and corporate accounts. But as of right now, you can just look at maybe around $3,000 of a deduction that you can take from losses. So basically what that means is if you lose $3,000, you won't be liable for paying taxes on that $3,000 loss, right? And anything after that, and this is for joint filing, married filing joint, right? Married filing joint. If you're married filing separate or you're single, then that basically gets chopped in half. So now you're dealing with a $1,500 loss write-off, basically. So the regular tax rate for most individuals is probably going to be around 25%. I tell everybody to just set aside 30%, right? So yes, we're talking about getting a 10% gain on $500 with a $10,000 account. You make $50. Take 30% of that, set it aside, and just understand that at some point when it's time for you to file for your taxes, the money's already there. You don't have to go and dip into, because one thing that you don't want to do is you don't want to get to the point where you don't have that profit set aside because you already spent it. And now when that tax bill is due, you have to dip into your account balance and pay the IRS. That's not what you want to do, all right? You want to continue to grow your account. You never want to get to the point where you're actually subtracting from your account, because every time you subtract from your account, you're lessening your position size. You want to keep your position, you're lessening your position weight. You want to keep that weight, right? You want to grow the weight. You don't want to decrease the weight, right? Especially when it pertains to taxes and not being responsible enough to hold that money aside. Now, I say 30%, which is probably more than what you'll end up owing, but just hold that 30% aside. Now, a lot of people, man, I don't want to pay the IRS nothing. I don't want to, it's not their money. It's not that. Yes, but at the same time, you know, we're living in America. This is the land of opportunity. What other place can you go to that's going to give you the opportunity to raise your own capital, put money into your own brokerage account, and make money off of your own money by using companies that you don't even play a part in? I don't even own, I don't play any part in Etsy. I don't know the CEO. I don't work for them. I don't know where their headquarters is at. I don't know much about the company. All I know is it was a great setup. I got some money. I put some money into the setup, and I'm up. I'm up 10.83%, almost 11% now. It goes up and down, but for the most part, I'm up 11%. I made an extra couple $100, right, off of trading this company, and I'm just sitting in my chair right now. I don't have no problem cutting the IRS 30% of my profits. You shouldn't either. It's free money, basically. So there's it shouldn't be any complaints about setting money aside and paying the IRS and doing this and doing that. That's your obligation as a citizen in the United States of America. And to be honest with you, if somebody's giving me the opportunity to make free money that I didn't have to work for, I wouldn't mind cutting them a piece of that anyway. So it's something that shouldn't even be an issue. All right. So just use this as a guide. And if you have any more questions about taxes, definitely hit us up. You can go to wisetaxfinance.com or you can contact me directly. on my personal page, or you could follow at Wise Tax Finance on Twitter, Wise Tax Finance on Facebook, Wise Tax Finance on Instagram. And we're here, we're available. We answer any questions you need. And if you also need tax preparation or any advice pertaining to personal financial planning, credit consulting, business consulting, or any of that, we're here for you, and that's what we do. All right. So that's pretty much it as far as the risk management class. And that's a wrap for swing trading. So again, if you guys have any questions, anything that you want to discuss, let me turn this screen share off. Anything you guys want to discuss moving forward, I'm here. Obviously, there is a chat available. We have a Discord group that's available for anybody who's interested. You could just go to bstuniversity.com and sign up for the VIP group. We're operating out of Discord. We also have a weekly group meeting via Zoom every single Sunday, 7 p.m. Eastern time. And we also have one-on-one mentorship available. So I know this stuff is a lot. There's a lot of information, might be a little bit too much for some of us to grasp. I'm here for you. If you're interested in getting a one-on-one mentorship, all you have to do is go to bstuniversity.com, sign up for the one-on-one mentorship, and we're going to have a schedule for you sent out. You'll get about 2 or 3 hour session, the first session, and then you'll get an additional 2 sessions after that for follow-up, and we'll be able to just be there for you and take care of any questions or any concerns or anything you're stuck with will be solved on those calls. All right. So we're available for you. Also, make sure you check out the other courses that we have available, like the options trading course. We have technical analysis courses that go into more detail about some of the things that we talked about, some of the tools that we talked about. You also have a Fibonacci course as one of the tools that a lot of people who are in the market from a day-to-day basis use. Very, very high profitability when it pertains to getting in and getting out of these trades if you're dealing with the Fibonacci retracement tool. Also, we have chart pattern cheat sheet courses, candlestick cheat sheet courses, and all those things available for you if you want to expand on your education and learn more about this game. All right. Thank you guys for joining, and I hope you have a great trading journey. All right. Peace.